You've probably heard the news by now. The Federal Reserve has reduced interest rates once again, marking another shift in monetary policy as we approach the end of the year. On the surface, this seems like unambiguously positive news. After all, lower rates typically translate to reduced borrowing costs and provide some economic stimulus. But here's what's fascinating and, frankly, a bit frustrating for many Americans. The anticipated relief hasn't materialized in most people's daily financial lives. Your credit card statement still arrives with that same uncomfortably high interest charge. The mortgage rate you're quoted looks remarkably similar to what it was months ago. And that savings account you've been nurturing, the interest it's generating has actually decreased, not increased. This gap between policy announcements and personal experience is precisely why understanding the mechanics behind these decisions matters so much more than just reading the headlines. Today, I want to have an honest conversation about what these rate adjustments actually mean for your financial situation. We'll explore why the benefits don't arrive instantly, where you might see changes first, and most importantly, what strategic moves you can make right now to position yourself advantageously, regardless of what the Federal Reserve does next. But before we dive deeper, I'm genuinely curious about your perspective. When economic news breaks about interest rate changes, what immediately crosses your mind? Are you thinking about student loan payments, mortgage refinancing opportunities, the return on your emergency fund, or perhaps broader concerns about cost of living and economic stability? Your experiences and concerns matter, so I encourage you to share your thoughts. Let's establish the facts. As we move through the final weeks of 2025, the Federal Reserve implemented another reduction to its benchmark interest rate. This represents the third consecutive cut, bringing the federal funds rate to a range between 3.5% and 3.75%. Since the Fed initiated this easing cycle back in September 2024, we've witnessed a cumulative decrease of approximately 1.75 percentage points. When you step back and look at the trajectory, that's actually quite substantial. However, and this is the critical nuance that often gets overlooked, Federal Reserve rate cuts don't instantly translate into changes across your personal financial landscape. The mechanism is more complex than many realize. The Fed controls one very specific rate, the federal funds rate, which is essentially the interest rate that financial institutions charge each other for overnight lending. Everything else in your financial life, mortgage rates, credit card APRS, auto loan rates, savings account yields, these are influenced by the federal funds rate, but they're not directly determined by it. Think of them as distant relatives rather than identical twins. Sometimes these rates move in tandem quickly, sometimes they lag significantly, and sometimes they barely respond at all. What made this particular rate decision especially noteworthy was the level of internal disagreement among Federal Reserve officials. The vote concluded at 9-3, representing one of the most divided decisions we've observed in recent years. This dissent is relatively uncommon and reveals important fault lines in economic thinking right now. Some officials advocated for an even more aggressive cut because they're primarily focused on employment concerns and want to prevent any labor market deterioration. Others resisted cutting at all, maintaining their vigilance about inflation risks that haven't been fully extinguished. Fed Chair Jerome Powell acknowledged this division openly, characterizing the debate as both passionate and professional. This transparency tells us something significant. Even the experts charged with guiding monetary policy are navigating considerable uncertainty about the economic trajectory ahead. Speaking of uncertainty, let's address the inflation situation honestly. Yes, inflation has moderated considerably from the alarming peaks we experienced a couple of years ago. Nobody's arguing otherwise, but here's the challenge. It hasn't fully retreated to the Fed's target zone, and that remaining distance is proving stubborn. The Fed's preferred inflation gauge, the Personal Consumption Expenditures Price Index, continues to hover around 2.8%. Now, to the average person, that might seem tantalizingly close to the Fed's 2% target. We're talking about less than a single percentage point difference. But in the world of central banking, that gap represents a meaningful challenge. The Fed doesn't view 2.8% as close enough because their credibility depends on hitting their stated targets. Many economists are now warning that bridging this final gap could prove more difficult and time consuming than anyone initially anticipated. Several structural factors are complicating the picture. Proposed tariff policies that could raise import costs, ongoing geopolitical tensions affecting energy and commodity markets, and wage pressures that have become embedded in certain sectors of the economy. These aren't temporary blips that will quickly fade. They represent persistent upward pressure on prices. Simultaneously, we're starting to observe subtle but concerning signs of weakness in the employment market. The unemployment rate has climbed to approximately 4.4%, marking the highest level we've seen in several years. Now, before anyone panics, this remains well below crisis levels. Historical context matters here, but the direction of movement concerns policymakers, and the rate of change deserves attention. This creates the classic monetary policy dilemma. The Fed is attempting to walk an incredibly narrow path. They want to support employment and prevent economic contraction, but they can't be so aggressive that they reignite inflation. It's like trying to adjust a thermostat in a house where some rooms are too hot and others are too cold. Whatever you do, someone's uncomfortable. Now let's get practical and address the question everyone's really asking. How does this affect my money specifically? Let's start with savings, because this category generates the most confusion and, frankly, the most disappointment. If you're banking with one of the major traditional banks, you've probably noticed that your regular savings account is still generating almost nothing in interest. We're talking about rates so low they're essentially rounding errors. Despite all the rate cut news, these accounts haven't changed much because they were already paying virtually nothing. High-yield online savings accounts tell a different story, though it's not entirely positive either. A year ago, competitive online banks were offering rates around 5% or even slightly higher. Those were genuinely attractive returns for completely liquid, FDIC-insured savings. Fast forward to today, and many of those same accounts are now yielding somewhere in the mid 3% to low 4% range. So yes, the Fed's rate cuts have had a direct impact here. Your savings are earning less than they were. However, here's the important perspective. Even at 3.5% or 4%, you're still earning a real return above inflation if you've positioned your money strategically. The key phrase there is, if you've positioned your money strategically. This isn't automatic. It requires actively seeking out competitive rates rather than accepting whatever your default bank offers. Money market funds present another interesting case study. These funds, which many investors use as a cash alternative, were yielding close to 5% during the summer of last year. Today, you're looking at rates closer to 3.7%. That's a noticeable decline, and if you've been using money market funds as a parking spot for substantial cash reserves, this is an appropriate time to reassess whether this remains the optimal choice for your specific situation and time horizon. Here's something that often surprises people. Treasury bonds remain quite attractive despite all the rate cutting. The 10-year Treasury note is still yielding slightly above 4%, which is historically quite reasonable. Municipal bonds, particularly those issued by financially sound states and municipalities, are also offering solid returns. The added advantage with municipal bonds is that the interest income is often exempt from federal taxes, and sometimes state taxes as well, if you're investing in bonds from your home state. For investors in higher tax brackets, the tax equivalent yield can be quite compelling. Many conservative investors are quietly allocating more money to these fixed income vehicles right now because the risk-return profile makes sense in the current environment. Now let's shift to the borrowing side of the equation, because this is where the gap between expectations and reality becomes most pronounced and most frustrating for many people. Mortgage rates represent the biggest disappointment for many hopeful homebuyers and homeowners considering refinancing. Despite the Fed's rate cuts, mortgage rates have remained stubbornly elevated. A 30-year fixed-rate mortgage continues to hover around 6%, give or take a few tenths of a percentage point depending on your credit profile and the specific lender. This confounds many people. They see headlines about the Fed cutting rates and naturally assume that mortgages should become significantly cheaper. It seems logical. But here's the mechanism that explains why that isn't happening. Mortgage rates don't primarily follow the federal funds rate. Instead, they're much more closely tied to long-term Treasury yields, particularly the 10-year Treasury note. And those long-term yields have remained elevated because bond investors are wrestling with several concerns: the trajectory of government debt and deficit spending, the persistence of inflation pressures, and general uncertainty about the economic and political landscape ahead. Until those long-term yields come down substantially, mortgage rates will remain higher than many had hoped. Credit cards present their own painful reality. The average credit card interest rate has decreased slightly since the Fed began cutting rates, but we're talking about a modest decline from perhaps 20.8% to 19.8%. If you're carrying a balance, that incremental reduction barely makes a dent in your monthly interest charges. Credit card rates remain brutally high, and that's unlikely to change dramatically regardless of what the Fed does. This is actually a good moment to mention something actionable. If you're carrying credit card debt, sometimes taking direct action yourself can accomplish more than waiting for broader rate movements. Many people don't realize that calling your credit card company and simply asking for a rate reduction sometimes works, especially if you have a good payment history. Similarly, if you qualify for a balance transfer card offering a 0% introductory period, that can provide much more meaningful relief than any Fed rate cut will. Auto loans have eased somewhat, but again, we're not talking about dramatic reductions. The bigger challenge in the auto market isn't even the interest rate, it's the underlying price of vehicles. Cars and trucks remain near historical highs in terms of pricing, which means people are borrowing larger amounts than ever before just to acquire reliable transportation. Even with slightly lower interest rates, the total cost of financing a vehicle remains significant. There is one bright spot worth highlighting: home equity lines of credit, commonly called HELOCs. These rates have actually declined more noticeably, falling from the 9% to 11% range down to somewhere in the high 7% range. For homeowners who have accumulated equity and need flexible access to capital for renovations, debt consolidation, or other purposes, this represents a meaningful improvement. HELOCs deserve consideration if you have substantial equity and a disciplined approach to borrowing. Let's take a moment to discuss how financial markets responded to this latest rate cut, because market reactions often provide insight into how professionals are interpreting these moves. Stock markets generally responded positively, with major indices posting gains following the announcement. Bond yields dipped modestly. The overall market sentiment suggested relief and optimism. However, the interesting nuance is what markets didn't do. They didn't price in expectations of aggressive, unlimited rate cuts extending far into the future. Instead, investors seem to interpret the Fed's message as cautiously optimistic but conditional. Jerome Powell's commentary essentially conveyed, "We're cutting rates to provide some support, but we're monitoring conditions closely, and we're not making any promises about what comes next." This measured approach actually reassured markets more than an aggressive cutting stance might have, because it suggested the Fed isn't seeing anything alarming enough to warrant panic-level intervention. It would be incomplete to discuss Federal Reserve policy without at least acknowledging the political context, even though the Fed is structured to operate independently from political pressure. President Trump has been quite vocal about his preference for lower interest rates, and he's been critical of Fed policy in the past when he felt rates were too high. Jerome Powell's term as Fed chair concludes in 2026, which means speculation about potential leadership changes is already beginning to percolate through financial circles. This matters because leadership and philosophy at the Fed genuinely influence the trajectory of monetary policy. Different Fed chairs bring different perspectives on the appropriate balance between employment and inflation concerns, different views on how proactive versus reactive policy should be, and different communication styles that affect market expectations. Market participants are already gaming out scenarios for potential successors and what their leadership might mean for rate policy in the years ahead. After all this context and analysis, let's focus on what matters most. What should you actually do with this information? First and foremost, recalibrate your expectations. Don't operate under the assumption that Federal Reserve rate cuts will automatically translate into immediate, substantial relief in your daily financial life. For most consumer financial products, the transmission mechanism is slow and incomplete. If you're waiting for dramatically cheaper borrowing costs before making major decisions, understand that patience will be required, and the relief may be more modest than you're hoping for. Second, conduct an honest audit of where your cash is currently positioned. If you have emergency savings or other cash reserves sitting in an account earning 0.5% or less, you're essentially losing purchasing power to inflation. That's a choice you're making, perhaps unconsciously. High yield online savings accounts and money market accounts remain available with rates substantially higher than that. Moving money isn't complicated, and the incremental return compounds over time. Third, if you're carrying high interest debt, particularly credit card balances, that should remain your absolute top priority, regardless of what the Fed does. The interest you're paying on credit card debt almost certainly exceeds any return you're earning on savings by a wide margin. Federal Reserve rate cuts don't solve this problem for you. Only you can solve it by aggressively paying down those balances or finding more favorable financing terms. Fourth, manage your expectations about the future path of rates. Many people anticipated that once the Fed started cutting, we'd see rapid, substantial reductions continuing indefinitely. That's not what's happening. The Fed itself is currently projecting perhaps one additional rate cut next year, possibly another one the following year, and then stabilizing at what they call a neutral rate, somewhere around 3%. That's not zero. It's not free money. It's simply more normal by historical standards. Here's that deeper point I mentioned at the beginning that doesn't get discussed enough in mainstream coverage. The Federal Reserve has navigated this type of situation before, and the historical lessons are informing current caution. During the 1970s, the Fed attempted to manage inflation while also supporting employment and growth. They implemented a pattern of tightening policy when inflation spiked, then loosening policy when the economy weakened, then tightening again when inflation resurged. This stop-and-start approach ultimately failed because it allowed inflation to become entrenched in economic expectations and behavior. It took the extremely painful, aggressive tightening under Paul Volcker's leadership in the early 1980s, which triggered a severe recession, to finally break that inflationary cycle. Current Fed policymakers are acutely aware of this history. They studied it extensively in their academic training and early careers. The caution you're seeing now, the measured pace of rate cuts despite political pressure and public frustration, reflects a determination not to repeat that mistake. They would rather move slowly and maintain credibility than cut too aggressively and risk allowing inflation to reestablish itself. This historical awareness is why Jerome Powell and other Fed officials consistently emphasize that their decisions are data-dependent and that they're not following a predetermined path. It's frustrating to those hoping for quick relief, but it's intentional and grounded in hard-learned lessons. When you see headlines declaring Fed cuts rates, that statement is technically accurate but fundamentally incomplete. The more honest headline would be something like, Fed cuts rates, but benefits will flow unevenly and slowly to different people at different times. Some individuals and businesses benefit from rate cuts almost immediately. Large corporations with floating rate debt see their interest expenses decline right away. Banks with variable rate loan portfolios see their net interest margins adjust. Wealthy investors with sophisticated strategies can quickly reposition assets to capitalize on rate movements. But for the average household, the benefits arrive slowly, incompletely, or sometimes not at all. Your mortgage rate might not budge. Your savings account yield might actually decline. Your credit card rate might edge down so modestly that you don't notice the difference. This uneven distribution isn't a conspiracy or a policy failure. It's simply how monetary policy transmission works in a complex modern economy with thousands of different financial products and millions of independent lending and borrowing decisions happening simultaneously. Let me pose a question for you to consider. When you examine your own financial situation right now, does it feel like things are improving, deteriorating, or simply evolving differently than you anticipated? There's no universally correct answer to that question. Personal financial circumstances vary enormously, but sometimes simply understanding why things feel stagnant or why expected improvements haven't materialized can provide its own form of relief. It helps to know that your personal experience aligns with broader patterns rather than reflecting some unique failing on your part. As we continue moving through this economic environment, I'd encourage you to embrace a specific mindset. Focus relentlessly on the variables within your control. You cannot control Federal Reserve policy. You cannot control inflation. You cannot control political developments or global economic forces. Those factors will influence your life, but they're beyond your direct influence. What you can control is where you choose to keep your savings and what interest rate you're accepting. You can control whether you carry high interest debt and how aggressively you attack it. You can control how informed you are about financial options and opportunities. You can control whether you periodically shop for better terms on financial products or simply accept whatever you currently have. These might seem like small adjustments, switching to a savings account, paying 4% instead of 0.5%, refinancing an auto loan to save half a percentage point, calling your credit card company to request a rate reduction. But these small optimizations compound over months and years. They accumulate into real money that stays in your pocket rather than flowing to financial institutions. The broader story of Federal Reserve policy, inflation, employment, and economic cycles will continue unfolding. There will be more rate decisions, more economic data releases, more political debates about monetary policy. I'll continue analyzing these developments and translating them into practical implications for everyday financial decisions. But regardless of what headlines arrive next week or next month, the fundamental principle remains constant. The most reliable path to financial security is focusing on what you can control, making informed decisions with the information available, and maintaining consistent financial discipline regardless of broader economic conditions. The Federal Reserve's rate cuts matter, but your personal financial choices matter more.